Imagine walking into your bank to check your balance and discovering accounts you never opened, credit cards you never applied for, fees you never authorized, your credit score damaged by accounts you didn't even know existed. Now imagine this didn't happen to just you. It happened to millions of people. And it wasn't a mistake. It was company policy. This is the Wells Fargo scandal, and it's one of the most disturbing examples of corporate fraud in American history. Not because of how much money was stolen, but because of how it was stolen, by thousands of low-level employees who were told that if they didn't commit fraud, they'd lose their jobs. Between 2002 and 2016, Wells Fargo employees opened approximately 3.5 million fake bank accounts and credit cards without customer authorization. That number was later revised upward. By 2017, investigators discovered the real number was closer to 8 million fraudulent accounts. 8 million. But here's what makes this story truly heartbreaking. The employees who committed this fraud weren't criminal masterminds. They were bank tellers and personal bankers making $12 to $15 an hour, working under crushing quotas that made fraud the only way to keep their jobs. Many of them hated what they were doing. They lost sleep over it. Some reported it to management and were fired for speaking up. Meanwhile, the executives who created this toxic system walked away with hundreds of millions of dollars. Today, we're diving deep into the Wells Fargo fake account scandal. How it happened, why thousands of employees felt they had no choice but to break the law, and why the people at the top faced almost no real consequences. This is a story about corporate greed, institutional cruelty, and what happens when a bank cares more about its stock price than its customers or employees. To understand how millions of fake accounts were created, you need to understand Wells Fargo's sales culture. And that culture can be summed up in one phrase. 8 is great. 8 products per customer. That was the goal. Checking account, savings account, credit card, debit card, online banking, overdraft protection, money market account, line of credit. 8 products. The thinking was that the more products a customer had with Wells Fargo, the stickier that relationship would be. They'd be less likely to switch banks. On paper, cross-selling makes sense. If a customer comes in to open a checking account and they mention they're saving for a house, offering them a savings account is good service. That's legitimate banking. But Wells Fargo didn't want legitimate cross-selling. They wanted numbers. Aggressive, unrealistic numbers that had nothing to do with what customers actually needed. Bank employees were given daily quotas. Not weekly, not monthly, daily. You needed to open a certain number of new accounts every single day, or you'd be called into your manager's office and humiliated. Former employees describe a culture of constant fear. Morning huddles where employees who didn't meet quotas the previous day were publicly shamed. Managers screaming at tellers in front of customers. Employees being told they were worthless, lazy, failures. One former banker described being forced to stand in front of colleagues while her manager berated her for missing her numbers. Another said his manager would throw staplers and binders when the team underperformed. These weren't isolated incidents. This was the culture. And the quotas kept increasing. 8 products per customer became the minimum. Some branches pushed for 10, 12, even 15 products per household. It didn't matter that most customers don't need 15 banking products. It didn't matter that opening unnecessary accounts could actually harm customers through fees and credit inquiries. All that mattered was the number. Employees who consistently met their quotas were celebrated as heroes. They got bonuses, recognition, promotions. They were held up as examples at regional meetings. But here's the thing. Many of these top performers weren't better salespeople. They were better at fraud. They'd figured out the system, and the system rewarded cheating. So how did the fraud actually work? It started small. An employee would open a checking account for a customer, which was legitimate. But then, to hit their quota, they'd also open a savings account without telling the customer. They'd transfer a few dollars from the checking account to make it look active. The customer might not even notice. It's just a small line item on their statement. Then it escalated. Employees would open credit cards in customers' names without permission. They'd create fake email addresses so the customer wouldn't receive alerts. They'd sign customers up for online banking using employee email addresses to intercept notifications. Some employees would target elderly customers who were less likely to check their statements carefully. Others would use information from new account applications to open additional accounts the customer never requested. And here's where it gets truly disturbing. Employees would sometimes use their own information or their family members' information to create fake accounts just to meet quotas. They'd open accounts in their spouse's name, their parents' names, even their children's names. One employee opened accounts for herself and 6 family members, including her teenage daughter. Another created fake personas entirely, opening accounts with fictitious information that couldn't be traced back to any real person. The fraud became industrialized. Employees developed techniques and shared them with each other. They'd coordinate to hit branch-wide goals. If someone was short on their numbers, colleagues would help by creating fake accounts using customer information they'd collected. And management knew. They had to know. Regional managers would visit branches and see employees frantically opening accounts at the end of the day to hit quotas. They'd see the same customer names appearing on multiple new account applications. They'd notice the unusual patterns. Why would a 75-year-old retiree suddenly need 5 credit cards? But instead of investigating, they'd congratulate the branch on exceeding goals. Because those managers had quotas too. Their bonuses depended on their region hitting targets. And their promotions depended on showing growth. The incentive structure guaranteed fraud. If you followed the rules and only opened accounts customers actually wanted, you'd be fired. If you committed fraud to hit your numbers, you'd be promoted. What would you do? Some employees quit. They couldn't stomach the pressure and the dishonesty, but many of them had families to support, mortgages to pay. Banking jobs don't transfer easily to other industries. And in the 2008 to 2016 period, jobs were scarce. Quitting meant potentially months of unemployment. So they stayed, and they opened fake accounts, and they hated themselves for it. One former employee described crying in her car before work every day. Another said he started having panic attacks. Many described feeling trapped, morally opposed to what they were doing but financially unable to quit. And when employees did speak up, when they went to HR or called the ethics hotline to report the fraud, they were fired. Wells Fargo had an ethics hotline specifically for reporting misconduct. Thousands of employees called it to report the fake accounts. And Wells Fargo's response was to investigate the employees who reported it, not for being whistleblowers, but for not being team players or failing to meet performance standards. Over a 5-year period, Wells Fargo fired approximately 5,300 employees for sales integrity violations. That's corporate speak for getting caught committing the fraud we pressured them to commit. But the executives who created the quota system, they kept their jobs, they kept their bonuses, they got richer. The scandal finally went public in September 2016 when the Consumer Financial Protection Bureau, the Office of the Comptroller of the Currency, and the Los Angeles City Attorney announced a joint settlement with Wells Fargo for $185 million. The details were stunning. 3.5 million unauthorized accounts, later revised to 8 million. Hundreds of thousands of customers charged fees for accounts they never wanted. Credit scores damaged by unauthorized credit card applications. Customers' money transferred between accounts without permission. And the scope was breathtaking. This wasn't a few rogue employees in one branch. This was systematic fraud across thousands of branches in every state for more than a decade. The CEO at the time was John Stumpf, who'd been with Wells Fargo since 1982 and CEO since 2007. The scandal happened on his watch. The toxic culture was built under his leadership. And for years, he'd been celebrating Wells Fargo's cross-selling success at investor conferences and in annual reports. When the scandal broke, Stumpf tried to blame low-level employees. He called them bad apples. He said 5,300 people had been fired for violating the company's ethical standards. He portrayed Wells Fargo as a victim of rogue workers who'd betrayed the company's values. Congress wasn't buying it. In September 2016, Stumpf was called to testify before the House Financial Services Committee. It was brutal. Senator Elizabeth Warren famously told him, "You squeezed your employees to the breaking point so they would cheat customers and you could drive up the value of your stock and put hundreds of millions of dollars in your own pocket. And when it all blew up, you kept your job, you kept your multi-million-dollar bonuses, and you went on television to blame thousands of $12 an hour employees who were just trying to meet cross-selling quotas that made you rich." She then called for his resignation and criminal investigation. The hearing went viral. Video clips circulated on social media. The public was outraged, not just at the fraud, but at Stumpf's attempts to blame frontline workers while protecting executives. Under enormous pressure, Stumpf announced he was forfeiting $41 million in unvested stock awards. Wells Fargo's board clawed back an additional $28 million. In October 2016, Stumpf resigned as CEO. Sounds like accountability, right? Except Stumpf walked away with approximately $130 million in compensation from his time as CEO. He lost $69 million, but kept $130 million. And he faced no criminal charges. The executive who ran the community banking division, where the fake accounts were created, was Carrie Tolstead. She'd overseen the division during the entire fraud period. She'd created the aggressive sales culture. And in July 2016, just before the scandal broke, she'd announced her retirement. She was allowed to retire with full benefits. Her exit package was worth $125 million. When the scandal became public, Wells Fargo clawed back some of her compensation, about $67 million. But she still walked away with nearly $60 million. And like Stumpf, she faced no criminal charges at the time. Meanwhile, the 5,300 employees who were fired, many of them struggled to find new jobs in banking because Wells Fargo had reported them to industry databases as terminated for misconduct. Their careers were destroyed while executives retired as multimillionaires. The injustice was staggering. The $185 million settlement in 2016 was just the beginning. As investigators dug deeper, they found more fraud, more victims, more damage. In 2018, Wells Fargo was fined an additional $1 billion by the Consumer Financial Protection Bureau and the Office of the Comptroller of the Currency for mortgage abuse and auto insurance fraud. Yes, there were additional scandals beyond the fake accounts. Wells Fargo had also been charging customers for auto insurance they didn't need and forcing unnecessary mortgage fees. The Federal Reserve took an unprecedented step. They capped Wells Fargo's asset growth until the company could prove it had fixed its governance and risk management. This was a massive penalty. It meant Wells Fargo couldn't grow, couldn't compete effectively, couldn't take advantage of market opportunities. The cap wasn't lifted until 2024. That's 8 years of restricted growth. Class action lawsuits piled up. Customers sued for the unauthorized accounts and fees. Shareholders sued for being misled about the company's sales practices. By 2020, Wells Fargo had paid over $3 billion in settlements and fines related to the fake account scandal. And the human toll? Incalculable. Customers had their credit scores damaged, which affected their ability to get mortgages, car loans, and jobs. Some were denied credit for years because of inquiries they never authorized. Others paid hundreds or thousands in fees for products they never wanted. The employees who committed the fraud carried guilt and shame. Many described feeling like criminals, even though they'd been coerced into breaking the law. Some faced financial ruin after being fired and blacklisted from the banking industry. And the employees who'd tried to do the right thing, who'd reported the fraud and been fired for it, they faced years of unemployment, damaged reputations, and the knowledge that their integrity had cost them everything, while the executives who retaliated against them kept their fortunes. In 2020, the Department of Justice finally brought criminal charges, not against executives, but against Wells Fargo itself. The company agreed to pay $3 billion and admitted to misleading investors and committing fraud. But still, no individual executives were prosecuted criminally. Then, in 2023, 7 years after the scandal broke, the SEC finally charged Carrie Tolstedt with fraud. She was accused of misleading investors about the fake accounts problem, even as she knew how widespread it was. She settled the charges, agreed to a $17 million penalty, and accepted a bar from serving as an officer or director of a public company. And in March 2023, federal prosecutors finally brought criminal charges against Tolstedt for obstructing bank examinations. In 2025, she pleaded guilty and was sentenced to 3 months in prison. 3 months. For overseeing fraud that affected millions of customers over more than a decade. Meanwhile, John Stumpf was charged by the Office of the Comptroller of the Currency with failure to oversee the bank properly. He paid a $17.5 million fine and accepted a lifetime ban from the banking industry. No prison time, just fines paid from his $130 million fortune and a ban from an industry he'd already retired from. So what do we learn from Wells Fargo? First, corporate culture matters. When you create a system where employees must choose between their ethics and their paychecks, many will choose their paychecks. That doesn't make them bad people. It makes them human. The real villains are the executives who designed a system that required fraud to succeed. Second, metrics and quotas can be dangerous. Wells Fargo's obsession with 8 products per customer divorced sales goals from customer needs. The number became more important than the service. And when you measure the wrong things, you incentivize the wrong behavior. Third, whistleblowers need protection. Thousands of Wells Fargo employees reported the fraud through proper channels, and they were punished for it. If we want people to speak up about corporate misconduct, we need laws that actually protect them, not just on paper, but in practice. Fourth, accountability must reach the top. Low-level employees went to prison. Mid-level managers lost their careers. But the executives who created and profited from the toxic culture, they paid fines from their vast fortunes and retired. Comfortably. That's not justice. That sends a message to every CEO in America. You can oversee massive fraud, ruin thousands of lives, and as long as you maintain plausible deniability, you'll never see the inside of a prison cell. Finally, we need to recognize that corporate crime is still crime. If a person breaks into your house and steals $1,000, they go to prison. If a corporation steals millions through systematic fraud, they pay a fine that's a fraction of their annual profit and nobody goes to jail. The Wells Fargo scandal affected millions of Americans. It damaged credit scores, destroyed careers, violated trust, and exposed the rot at the heart of one of America's largest banks. And the punishment? A few billion in fines, which Wells Fargo could afford, and almost no prison time for the people responsible. Wells Fargo still exists. It's still one of the largest banks in America. It's still making billions in profit. And while the company claims to have reformed its culture, changing compliance rules is easy. Changing the fundamental incentive structures that reward short-term profit over long-term ethics? That's much harder. The employees who were pressured to commit fraud will carry that guilt forever. The customers who were victimized will remember the violation of trust. And the executives who created the system that made fraud inevitable, they're enjoying their retirements. If that doesn't make you angry, I don't know what will. The Wells Fargo scandal isn't just about fake accounts. It's about what happens when corporations value growth over people, when executives escape accountability, when workers are treated as expendable, and when the justice system treats white-collar crime as somehow less serious than street crime. 8 million fake accounts. Thousands of employees coerced into fraud. Millions of customers betrayed. And at the end of it all, the people at the top walked away rich. That's the real scandal. Not what happened, but who paid the price for it. The next time a bank asks if you want to open another account, remember Wells Fargo. Remember the tellers who were crying in their cars because they hated what they were being forced to do. Remember the customers who discovered accounts they never opened. Remember the executives who got rich off fraud and faced almost no consequences. And ask yourself, has anything really changed? Or are we just waiting for the next scandal? 8 million fake accounts, thousands of coerced employees, and executives who walked away rich. This is corporate fraud at its worst. If this story opened your eyes to how broken the system really is, hit that like button and subscribe for more deep dives into corporate scandals. Drop a comment with your thoughts. Do you think justice was served? What business scandal should I cover next? Your engagement matters. Thanks for watching, and remember, always read your bank statements.